Audio Jungle. Audio Jungle.
What caused the financial crisis? From August 2007 until September 2008, there was very wide agreement that poor incentives in the United States mortgage industry had caused the problem. What had happened was that the way the mortgage industry worked had changed significantly over the years. Traditionally, banks would raise funds, screen borrowers, and then lend out the money to those approved. If the borrowers default, the banks would bear the loss. This system provides good incentives for banks to carefully assess the credit worthiness of borrowers. Over time, that process changed and incentives were altered. Instead of banks originated mortgages and holding on to them, what happened was that brokers and also some banks start originating them and selling them to be securitized. This process is termed the originate and distribute model. The originators, the brokers, and the banks were paid based on the number of mortgages that they approved. So, their incentives were to sell as many mortgages as possible. Since they were selling them off, it was not their problem if the borrowers default. The second stage in the process of this new originate and distribute mortgage system was securitization. The entities that undertook securitizations, such as investment bank, would pool a whole set of mortgages together. These would be taken from across the country, so they would have good risk properties in terms of diversification. The securitizing investment bank would then tranche them so that the risk was spread differentially depending on the particular tranche owned. The buyers of the most junior tranche would be allocated any default losses first. Then, as more losses were accumulated, they would exhaust the lowest tranche and start to be allocated to the next most senior one, and so on up the seniority chain. There would have to be a large amount of losses before the most senior ones would bear any losses, so they were regarded as fairly risk-free and were rated triple A. More junior tranches would have lower ratings. Initially, with this new system, the most junior tranche would be held onto by the investment bank or other entity doing the securitization. If there was a problem, they would be hit first. The reasons for this was to provide good incentive to those doing the securitization to ensure that the originations and everything else was done properly. Increasingly, what happened was that all tranches were sold off, including the junior ones. This took away the incentive of those doing the securitization to check that everything was done properly. The study found that mortgages that were originated under the new originate and distribute model were of significantly lower quality than those originated under the traditional system, where they were held on the originating bank's balance sheet. Since buyers of the tranche look at ratings, the question was, are the ratings agencies doing a good job? Many argued that the answer was no, because the agencies began to receive a large proportion of their income from undertaking ratings of the securitized product. The idea was that they start to lose their objectivity and to give ratings that weren't justified. It seems from the statement of the Federal Reserve and the Treasury at the time that initially this was the view that they took. However, as the crisis continued and then after the default of Lehman, the dramatic collapse in the global real economy made this view that subprime mortgages were to blame less and less plausible.
We shall argue that the basic problem that caused the crisis was that there was a bubble in real estate in United States and also in a number of other countries such as Spain, Ireland, and United Kingdom. What happened is that the bubble burst, and this has caused a huge problem in the securitized mortgage market and in the real economy. This bubble was a huge bubble. It was global in many ways. This is why the effects on the real economy were so large. The next question given this will is, what caused the bubble? We argue that there were two main causes. The most important reason that the bubble was so big in the United States was the policy of the Federal Reserve back in 2003. What they did to avoid a recession after the collapse of the tech bubble in 2000 and the 9/11 terrorist attack in 2001 was to cut interest rates to the very low level of 1%. This was at a time when housing prices were still growing quite strongly at a rate above 1%, even if they had only been growing at the rate of inflation, which was around 3%. The Fed suddenly created an incentive to go out and borrow at 1% and buy housings going up at 3%. In addition, there were various other aspects that made it advantageous to buy. These included the tax advantages of being able to deduct interest on mortgages, compared to no deductibility of rent payments, plus some other policies to encourage poor people to buy houses. All these seven factors created a huge demand for buying houses that led to an increase in house prices, and the process then fed on itself. When house prices start to go up 5 or 10% a year, then it becomes worth borrowing even after the Fed raises interest rates. Thus, the Fed's low interest rate policy was the first factor that really caused prices to take up in a huge way.
Thank you, Bishamon. I am going to talk about the recovery of the economy, but I am going to talk about the effect of them first. The panic started in the mid 2007. At that time when the panic starts, There is a consensus view about the mortgage debt security emerged. There is a loss of confidence spread to all structured financial assets. All of the assets suddenly became information sensitive, including the house, the estates, the government papers such as bonds and all of the state assets. Those institutions with greatest dependence on short-term debts, including ABCP, took the biggest hit. Commercial paper is a money market security issued by a large corporation to obtain funds to meet short-term debt obligations, and is backed only by an issuing bank or company promise to pay the face amount on the maturity date specified on the note. We can look at the graph during 2007. The asset back was all-time high. It indicates that the company issued commercial paper to gain more money, which means that they have short-term money that they used to in the past. However, commercial paper is not free money. It has to be returned back to real owner with the interest. So we can see that the year after 2007, many companies start to slow down. Even money market fund experienced runs and shift their holding to treasury assets. The preservation of the bank capital and the optimization of return on the bank liquidity. It means that the commercial banks stop funding private holdings, such as stock market or estate markets. It also means that the banks start to stop loaning to individuals or at least slow it down for people to get the loan from the bank. The bank began to preserve the capital and try to create liquidity as much as possible. The result is the international market is stressed. So take a look at this graph. The TED spread is the difference between the interest rates on the bank loans and on short-term the US government debt. In the years of the crisis, it is higher than ever. Exactly. Prices also reflected in the stock market performance. This index is updated monthly and is based on 11 financial market variables meant to capture stress in the US financial system. A supportive value indicates that the stress is above on the long-run average. The previous chart showed that the financial system is along the path to recovery. The house price is flattening out, stock market on the general upward path. The commercial paper and interbank spread are lower. The general indicators of financial stress is lower. Costs of issuing corporate debt have gone down. Even sub-investment grade company spread have gone down. Global issuance and corporate bond and loan is on a recovery. Bank regulators carried out stress tests on the larger banks in the spring of 2009. Those found short were asked to raise capital. Small banks have not been able to raise capital as easily, trying to rely on retained earnings. Financial crises originating in credit markets can take years to work themselves out. The action taken to resolve the crisis is the monetary policy. The government provides liquidity support for Federal Reserve, including capital injection by government. There is a Housing and Economy Act of 2008. It was designed primarily to address the subprime mortgage crisis. It was intended to restore confidence by strengthening regulation and injection capital into two large U.S. suppliers of mortgage funding. States are authorized to refi subprime loans using mortgage revenue bonds. Both acts would hope to recover The economy.